Welcome to this financial education video. In this session, we will discuss the different types of financial statements that are essential for anyone who wants to understand the finances of a company. We will cover the types of financial statements, the elements in financial statements, the benefits of financial statements, and of course the cash flow statement, which is critical for any business. Let's get started. To begin, let's get to know the four main types of financial statements that are used to analyze a company's financial condition. Income statement. The income statement provides a summary of the company's revenues and expenses during a specific period, typically 1 year or a quarter. It shows whether the company made a profit or incurred a loss in that period. In this statement you will see revenues earned from sales, minus expenses to calculate the net profit. Example: if your company earns 1 billion IDR in revenue and incurs 800 million IDR in operational expenses, the net profit would be 200 million IDR. Balance sheet. This statement shows the company's financial position at a specific point in time, reflecting its assets, liabilities, and equity. Assets represent what the company owns, liabilities show what the company owes, and equity reflects the owner's share in the company. The balance sheet helps assess the solvency of the company, whether it can meet its long-term obligations. Statement of changes in equity. This statement outlines changes in the company's equity during a given period. It tracks capital contributions, retained earnings, and dividends distributed to shareholders. This report is important to understand how financial decisions impact the company's ownership, and how profits are reinvested or distributed. Cash flow statement. The cash flow statement tracks the cash inflows and outflows over a period. It's crucial for assessing a company's liquidity, whether the company has enough cash to meet its short-term obligations. This statement is divided into 3 sections. Operating activities, which reflect cash generated from regular business operations, like sales receipts and operational payments. Investing activities, which capture cash used for buying or selling long-term assets. Financing activities, which show cash received from loans or issuing stock and cash paid out for dividends or debt repayments. The cash flow statement is very helpful to assess whether a company can generate enough cash to support its ongoing operations. Each type of financial statement contains important elements that provide detailed insights into a company's financial health. Let's explore these elements further. Assets are resources owned by the company that are expected to provide future economic benefits. Assets are divided into 2 categories: current assets, which are expected to be converted to cash or used within 1 year, such as cash, receivables, and inventory. Non-current assets, such as property, plant, equipment, and long-term investments. Next, liabilities are debts that the company owes. These are also divided into current liabilities, which are debts to be settled within 1 year, such as accounts payable and short-term loans. Non-current liabilities, such as long-term loans or bonds payable. Next, owner's equity reflects the remaining value after liabilities are subtracted from assets. This represents the owner's stake in the company, and it can come from initial capital invested or retained earnings. Next, revenues and expenses in the income statement. Revenues represent the money earned from sales of products or services, while expenses represent the costs incurred to operate the business. Financial statements offer many benefits, both for the company itself and for external parties. Here are some key benefits of financial statements. Assessing financial performance. Financial statements help management evaluate whether the company is on track to meet its financial goals. Managers can use this information to identify areas that need improvement or optimization. Guiding investment decisions. Investors rely on financial statements to assess whether a company is a good investment opportunity. They look at ratios like return on equity, ROE, price to earnings, P ratio, and others to decide whether the company offers the potential for returns that justify the risks. Increasing transparency and accountability. Financial statements provide transparent information about the company's financial condition, which allows shareholders, regulators, and the public to better understand the company's performance. Supporting financial planning and management. Financial statements help companies plan their funding needs.